Thank you to everyone for joining and tuning in. I am Jacob, the Operations Coordinator for Redline Business Advisors, and joining me are Nancy, our President, and Dylan, our CEO. Welcome to our webinar called Stop Overpaying the IRS. And with that, I'm going to let you take it away, Nancy, and I'll get our presentation up on the screen.
Thanks, Jacob. So as Jacob mentioned, I am Nancy Williamson, CPA. Dylan is my son. He's our tax strategist and a diesel truck enthusiast. We help shop owners get real visibility into their numbers, not just for tax season, but for everyday decisions. This webinar is a part of a series we're doing to bring clarity to one of the most frustrating questions we hear from all of our shop owner clients. Why do my books say I make money, but my bank account and my tax bill each April 15th tell a different story? So that's what we're trying to solve, is helping you understand how to get the answers to those questions. Today, we're going to show you how the big, beautiful bill that was passed in July of this year offers some planning opportunities for you. So we'll go over the differences in what the old bill was, what the new bill is, and how to take advantage of the opportunities presented to you before it's too late. So we'll get into that in just a little bit. As I mentioned, we work exclusively with automotive shop owners. Our entire mission is built around helping you go from reactive to proactive, so you're not just scrambling to survive tax season or guessing at cash flow. Our services include providing monthly bookkeeping, profit first based cash flow management, tax strategy, and of course, tax prep. We also offer fractional CFO services all under one roof to try to prevent the going back and forth and the business owner being the middleman between your professionals. So our goal is a simple promise. It's to help you understand your numbers, protect your profit, and create real financial peace for you and your family. It's our way, these webinars is our way of showing shop owners and helping them move from just staying afloat to running a business that actually thrives. So let's get into it. Could do a little bit of housekeeping and explain our previous webinars and our future webinars and how to find them. So previously we talked about on our last webinar, webinar number 3, where did the money go? We looked at why so many shops look profitable but still struggle with cash. We broke down timing, pricing, and overhead, not just expenses, where the real cash flow is. We walked through 5 cash flow levers every shop needs to monitor and how to adjust. We showed how bookkeeping equals true visibility and help cash clarity lead to better tax and owner cash strategies. We also introduced Profit First. We are Profit First professionals authorized by the author of Profit First, Mike McAllowitz. So we're big fans of his and his writings. He writes a lot of good books. So you can watch all of our webinars on YouTube. You can search YouTube, Redline Business Advisors, or visit our website at redlineba.com and look under blogs, and all of our webinars will be posted there. Future webinars will include profit or just busy, why revenue alone doesn't equal success, and the owner's scorecard, how to track the right numbers to run the business, not just do the work. So with that, we'll get into what you're going to learn today, Dylan.
Yes, ma'am. So kind of our table of contents here. Why waiting until tax season is too late to save? We're probably going to hit this a whole bunch of times, but the point we're trying to drive home is as soon as December 31st rolls around, ends, and it hits the new year, there's not a whole lot we can do anymore. We're just basically reporting what happened. To do tax planning, tax strategy effectively, proactively, and get the best bang for your buck, you have to do it in this tax year. So that's why we're doing this now. It's October 1st. This gives us 3 months of time to make decisions, and that's why we're doing this. So we're gonna hit on that several times. Tax moves you can make right now. Again, we got 3 months, so we want to give you all some tools to use now to lower your tax bill. We're gonna go over the one big beautiful bill. the role of entity structure, equipment purchases, timing in your tax strategy, buying vehicles, that kind of stuff. And lastly, how profit first system helps you plan for taxes. So why this webinar matters. Taxes isn't just about filing, it's about controlling outcomes. There are so many tools available to business owners to lower their tax bill. Some of them are very easy. Some of them are, very, you need to be aware of them to be able to take advantage of them. Sometimes you're already using them, but how do we use them even more? So we want to talk about that, talk about the opportunities the One Big Beautiful Bill is going to give us. And again, as soon as January hits, strategy's off the table, right? We're just reporting what happened then. If you don't have a CFO or a fractional CFO, a virtual CFO, you need to be aware of things to be your own CFO then. And that's a big thing we want to give you here, or give you the tools to meet with one of our CFOs to pick their brain. So slide. Common ways shops overpay taxes. I believe, Nancy, you're taking this over from here. No, you didn't mean to look. Okay, it's me still. All right, common ways shop overpay. When you go and you say, "Oh, well, I've got a tax preparer, so they're going to help me save money." Your tax preparer, when it comes down to being in April, is just taking what the books say and putting it in the tax return, right? It's not time to sit down and strategize on ways to do this better. It is go time to hit deadlines and have that tax return compliant, complete, and out the door. So, relying on that is not a way to save money. How you save money is tax planning ahead of time. Okay. I don't know if we've hit that enough. That's the third time I've said it in 2 slides. I bet we'll say it a few more times. Missing deduction due to poor categorization. This is a big one. This is, Redline's business motto is it all starts with the books. And this is part of that, right? Missing deductions due to just not knowing they're there, your P&L being a mess, not realizing that you have the opportunity to take advantage of it. Or we've seen some pretty entertaining ones where people are like, I'm operating at a loss. I don't have to worry about this. And then you go look at how expenses are categorized, and you're like, yeah, those aren't allowed. Can't take that one. Sorry. Now you're in a profitable position, and now we have a tax problem, right? So having your book straight, knowing what your deductions are. Buying equipment without timing it strategically. A lot of people don't realize that just buying your equipment does not make it qualify. It has to be operational. You can't buy a 4-post lift on December 31st and think you're going to get the deduction. It's got to be installed. And you got to be able to drive cars on it and use it. And paying yourself the IRS's favorite way. There's, a ton of your salary's too high on your W-2 and your S Corp. There's so many different ways to take care of that. And that's, again, where a good CFO will help a ton. What tax planning really means. Yeah, you got to have clean numbers. It all starts with the books, right? If your P&L is an absolute mess, it's kind of hard to do any kind of tax planning, because how do we even know where things are at? And what's being allowed, what's not being allowed. There's a ton that goes into just being able to have clean books and know where you're sitting before tax season. Timing.
Ooh, I'm sorry.
Timing your spending intentionally, especially for cash basis taxpayers. Again, this also comes down to, if you're going to buy equipment, better make sure that it's operational. If you're going to buy a new vehicle, we need to make sure that we're putting business miles on it. There's a lot of things that go into timing of what you're purchasing, and planning ahead quarterly at a minimum, hopefully more so. Now I'm going to hand it over to Nancy in the One Big Beautiful Bill.
So I wanted to start with a couple things that change. I really cherry pick the One Big Beautiful Bill to just really focus in on the things that make a difference to shop owners. And so these are the 2 things that I think shop owners should be aware of from a personal standpoint, just as individual taxpayers. The first thing is that the tax brackets were lowered in 2017 when the first bill went through, but they were going to sunset and go back to the old tax rates in 2025. So the One Big Beautiful Bill made those lower tax rates that we've enjoyed for the last 8 years permanent. And then the other big change is that in 2017, we were limited to how much we could deduct for SALT, which is your local and state income tax, and your property taxes. So in 2017, that limit came in at $10,000. So we live in Texas, our property taxes are really high. And we were limited to what we could deduct on Schedule A to $10,000. If you live in California or Illinois or New York or any state that has state income tax, you were limited to deducting $10,000, or you were limited to deducting your property tax amount or your state income tax that you paid. The total limit was $10,000. That's all been increased to $40,000 effective with this bill. So this obviously put some good planning in your toolkit for the end of the year. Some of the things that I'm recommending to our tax planning clients is to pay their property taxes double. If you have a $15,000 property tax bill, you paid it in January of 25, you can pay it again in December of 25 and get a double deduction in this year. So things like that, you really need to be aware of and talk to your tax provider prior to December 31st. So that's the individual tax bills that have changes in the tax bill that you need to be aware of. From a business standpoint, the great thing is that bonus depreciation is being reinstated permanently. So that lets you fully deduct qualifying asset purchases right away as long as they are in use. It's not enough to just purchase them. You have to have them installed and in use. Section 179 cap has also increased. So Section 179 and bonus are very closely aligned. The key differences between bonus depreciation and Section 179 is that bonus will let you go into a net operating loss position. So if you made $10,000 and you bought equipment that was $20,000, you would be able to deduct a net operating loss of $10,000. Section 179 limits that. So you can't go negative with Section 179. So that's the big difference between the two very different tax planning opportunities. The other thing that happened was that the 20% QBI deduction was extended. So this is a huge thing for business owner. Every business owner gets a 20% deduction of their net operating income on their personal tax return, and that was made permanent. So that's a new deduction in 2017, and it's been made permanent. So some smart moves to make before December 31st, right? I know Dylan has already touched on this, but it's really important to time your equipment purchases strategically. You only get 100% bonus depreciation or Section 179 if the asset is placed in service by the year end. Be sure and talk to your tax preparer about optimizing your entity structure to make sure that you're doing everything you can to get the most 20% deduction on your personal tax return for QBI. That's really, really important. Be sure and review your tax estimates. Everyone is required to make estimated tax payments, and it's especially important for business owners who might be trying to optimize their tax position by not having a high W-2 wages. So be sure and review your estimated tax payment requirements with your tax preparer. The penalty for not making them timely is 8%. So this is something that's always been in effect, but now the 8% tax penalty, because interest rates are so high, is really making this a big deal. And a lot of people are caught unaware on April 15th that they have this estimated tax penalty payment.
Well, and before,
penalty.
I think the penalty was only like 2%, where it was
so
like, it wasn't very painful. Now you go to 8% and you're like, ooh, that might hurt.
Right. So be sure and talk to your tax preparer about estimated taxes. They're due on a weird quarterly status. It's January 15th for the previous year, April 15th, June 15th, and September 15th. So it's kind of a weird schedule. And then plan your distributions carefully. I know Christmas is a big time. You're going to want to take money out of the business and make sure that you've got money to cover all your Christmas presents for your family, but be careful about taking too much in distributions and triggering some unnecessary taxes. So those are some things that you can review with your tax preparer starting now.
All right, case study. So we're just going to kind of give a real world example of how we can take advantage of some of these things like bonus depreciation in particular. This is definitely one of the best ways to do it. Equipment is easy. We'll talk about vehicles after this, but case study, say you've had a killer year. You've got three shops that are just making a ton and you have a ton of profit and things are going well, right? Well, we could say in November, you're going to go purchase $250,000 in lifts, alignment machines, tire racks, anything you can think of. Go pay off the Snap-on truck, all that good stuff. You got to put it in service before December 31st, right? So get that lift installed, all that good stuff. So it's operational. Let's say you financed it. You don't even have to pay cash for it. You're going to take 100% bonus depreciation, even though you financed it. So you bought $250,000 of stuff. Let's say you put $10,000 down and financed it. You're still getting $250,000 in bonus depreciation, right? If you were still profitable at the end of that and not going into a income loss position, at a 20% tax bracket, you'd save $50,000 in taxes for $10,000 down, right? You still got to buy all that equipment. You're moving some money, but if business is good, $50,000 in tax savings today is pretty awesome, right? That deduction would disappear if placed in service in January. So you bought the lift, set it over on the side, didn't install it till January 1st. You don't get to take it till the following year. So got to be aware of that, got to be operational. It does not matter how you purchase it, and you will get bonus depreciation out of it. So it's a really big, awesome deal, especially for equipment, especially for shops that have so much equipment. Vehicle purchases. Now, vehicles get a whole lot more complex in many different ways. The biggest thing, two big parts of vehicle purchases. One, business use. We're going to talk a lot about business use versus personal use. It's kind of hard to use, a vehicle lift as personal use inside your shop, right? That's why there's not a lot of back and forth on that, because it's pretty much just a business asset. But your vehicle, driving over to the grocery store, taking the kids to baseball, all that good stuff is all personal use. Okay. You can deduct 100% of your vehicle, but it has stipulations on it. One is the biggest use, business use based on mileage. That is how the IRS decides what's business and what's personal. You must track your mileage. There's a ton of apps out there for it. And say, hey, this is a business trip, this is a personal trip. At the end of the year, it had to be at least 51% used for the business to be considered a business vehicle, right? So that's, first of all, 51%. The other thing, though, is you can only take your bonus depreciation based on your business use percentage. So if you said, hey, I drove 10,000 miles with my truck, 1,000 miles of that was personal use, you're only going to get to take 90% depreciation because that 10%, was personal use. There are some little things that you can do that are hard to argue with, like if you buy the vehicle and drive it to your shop and work with it on December 31st, that's all business mileage. It's 100% right there, right? Like, boom, no personal use whatsoever, 100% business. Okay. So there's that, right? Business use is one. The other is the class of vehicle. They break this down into quite a few different classes, from trucks to vans to sedans to EVs to weight limits, all kinds of stuff. Is your truck got a utility bed versus a normal bed, right? There's all kinds of different classes of vehicles. The biggest one is that you get 100% depreciation on is vehicles over 6,000 pounds. An F-250. My wife is desperately wanting a G-Wagon that's over 6,000 pounds, Tahoes, Suburbans, all of those things that are over 6,000 pounds, you get 100% depreciation. You buy a Honda Civic, I think it maxes out at like $18,000. It's a big difference. So definitely be consulting with your tax advisor in this tax year on what you're buying. Okay, it makes a big, big difference. Couple of questions that Nancy and I get on a very regular basis about
Not
this.
even just a couple. It's not even a couple. This is routine all the time, constant. Everybody wants to know how to write off their vehicle.
Yes. And some of them are pretty fair questions where the first time we got asked, it's like, I'll have to go look that up. And then after a while, you're like, okay, I got this. Like, for example, Hey, if I put a magnetic logo on the side of my truck with my business name, that's 100% business use, right? Everywhere I go, it's a marketing engine for me. I get to write 100% of it off. Yeah, no, yeah, it's not things, unfortunately. You could
So
make your truck
whether
look like a billboard and it wouldn't matter.
That's right. It doesn't make any difference. It all comes down to business and personal use. So that's one key difference. We hear like people say, "Hey, I bought a vehicle. It's got a logo on it. I wrapped it to make it look like a billboard." I don't care. Where's your business mileage log? That's the next thing I
If
answer.
you're
Doesn't make
driving
any
to your
difference.
kid's football game, it's not business. Doesn't
Yeah,
matter.
it's not business.
Another one we get, hey, well, we get this in multiple ways. If the car is in my business's name, then it's the business's, and that's 100%. No, it's not. But also, your business vehicle should be in your business's name. The amount of people that buy a vehicle for their corporation and put it in their own name, like, no, it's you got to put it over there. It's got to go with the business. But no, even if it's in the business name, which it should be, it's not 100%.
Yeah, it doesn't make it 100% deductible. Still have to have a business model.
Commuting. This one's hard, right? This is a frustrating one. Commuting to and from work is not business mileage. Okay. You leave your house in the morning, drive down to the shop, drive home at the end of the day. None of that was business mileage. Now, this is where having a tax strategist comes in play when you establish if you have two or three shops and you have a home office. Now I'm not commuting because I'm already at my office when I leave the house. Now I'm doing shop visits, and that's all business mileage. So there's games you can play with that, but definitely consult your CFO, tax strategist, all that good stuff.
Yeah. So
Um,
business owners who have multi locations, home office is a big deal to maximize your business mileage deduction. And remember, if you have a home office, you can't have an office at the shop. Okay, so no room for you at the shop, no office for you at the shop. Your home is your office, and that's a great way to start your business mileage increasing way up.
then another one, do I have to track my mileage? I the technical answer is yes, but at the end of the day, in 3 years when you get audited, it's not me that has to stand for your mileage or not. So yes, the IRS says you have to track your mileage. If they come and audit you, it's kind of on you to argue it.
Yes. And it's so
So
easy now. There's so many good apps that connect to your vehicle, like just your vehicle, not, they used to track everything. So if you went out on a boat or if you were on public transportation, it would still track your business mileage. Now the apps have gotten smart and they hook to your Bluetooth and recognize your vehicle. So it really makes it easy to swipe right and left and provide that mileage log. We use Mile IQ. There's a ton of them. We
yeah,
use
my
Mile
IQ
IQ.
is usually we don't get any kickbacks. That's just the one we use. So if someone knows that people at Mile IQ, I wouldn't mind kickbacks. Speaking of that, can I estimate my mileage? That's cool, right? I can just say 10,000.
No.
No. In fact, the IRS hates round numbers. Even if a client has Mile IQ, sends me the entire breakdown and it's exactly 10,000, I'm going to put 10,002 on the tax return because IRS hates round numbers. So no, don't estimate, don't put round numbers. I cannot foot stomp that hard enough. How many times we have to say that?
Yes.
Uh, what if I borrow the truck on weekends? Do I have to track that? All personal use,
Yep.
all of it.
Yep.
If I finance the truck, do we still get the whole deduction? Yes, you do. Doesn't matter how you buy it. You can finance 100% of it, 2% of it, pay cash for it. Doesn't matter. You get it no matter what. If I buy it, and this is kind of one of the ones I was saying earlier, if I buy it in December and park it at the shop, does that count as in service? If it's available and ready for use and actually used before you're in, yes. Yes,
Yes,
it
it
is.
is.
You just leave it there. Can I write off my spouse's SUV too if she sometimes helps out? That's no, not really. There's a lot of content. Is she on the payroll? Does she help? Is she going to use that vehicle more than 51% for that business and willing to track all the mileage for it year after year? It's kind of, is it a true business vehicle? I know we love to play these games of, trying to pay the tax man more. But at the end of the day, if the tax man comes a knocking, he wants to know if you used it for your business. Is it actually used for it? And if your wife is just writing the deduction off and driving to Nordstrom's and hanging out, it's not going to count. Like that's an easy one to override. So if you want to write your wife or husband's vehicle off, you got to use some common sense here. Is it a business vehicle? Is it really a business vehicle? Because you're going to have to argue that in front of the man if he comes a knocking.
Now, let's not lose track of the fact that this is a huge deduction. Vehicles are crazy expensive. If an F-250 is $100,000 and you could write that sucker off all in 1 year, it makes a massive difference in your tax bill. And that's why all of these things are in place. And that's why, mileage logs have to be kept. So really,
it's the only way the IRS can decide if it's actually business or not. It makes sense.
Yeah, it does. It does. So big deductions come big paperwork nightmares, and this is one of them. So I hope this was helpful. Oh, and just as a caveat, we've talked a lot about depreciation, but you also the business gets to take the interest deduction, the insurance, repairs, gas,
maintenance.
Yeah, it's a good deal. It's a good deal. All right. So what do we need to do now that it's October 1st, right? Get your books cleaned up. That's the number one thing that you need to do. Is your CPA can't plan around garbage numbers, and you can't plan around garbage numbers, right? There's just no point in doing it. So get your books cleaned up.
My favorite by far, and I know I've told this story before, but it's good no matter what, is we had a client that said he didn't have a tax problem because he was at a massive loss because he thought a $1.8 million divorce settlement was tax deductible to his business. You're
Yes.
like, no, move that out of the books. Hey, you made a lot of money last year and you have a fat tax bill coming your way.
Yeah.
It's I feel like a farmer's insurance. We've seen it. We know a thing or two because we've seen a thing or two. It's like you can't. It's good entertainment though. After the fact,
It is. It is. So ask your tax professional to run a 2025 projection for you before December 31st. We start that process before Thanksgiving. We start pulling all the books, running projections, talking to people, talking to our clients about whether they're making money, losing money, and things that they can do before December 31st to offset their tax bill. Think about what you want to buy, like what would be helpful in the business. I always will encourage you to buy, lifts, alignment tools, and things that will help you make more money before I'll recommend you buy an F-250. But if you need an F-250, before December 31st is the time to do it. And then use the projection to time purchases and compensation. Remember your W-2 wages, 401k contributions, distributions. Consider all of those things before the end of the year. It will make a big difference in your planning. So how does Profit First support tax planning? I think this is the number one thing that, in my mind, that Profit First does beautifully, is that it requires you to allocate money to your tax account. So if you are making $100,000 in income every month, Profit First will want you to take 20% of that and put that in a tax account and just have it sit there. That way you have money to make estimated tax payments. You have money to plan for 401k contributions and things that you can do before the end of the year to lower your tax bill. And if you decide to forego all of that and just pay the tax man, your money's sitting there on April 15th to make those payments, avoiding interest and penalties. So this is where Profit First really, really shines. Buy the book, read the first 3 chapters. I guarantee you it will be life-changing if you implement it. And all of my auto repair guys that we work with are married to it. They love it. So I would highly encourage you to buy the book at
easy.
the bare minimum.
I mean, seriously, read the first 50 pages and you're like, I got it. That's
Yes.
pretty simple, right?
And if you don't like to read, buy the audio
book.
Mike narrates it himself and he's hilarious. So it's a really good audio book. So what are our key takeaways? And we are way over time. I know we beat this dead horse, but waiting until April 15th, it's too late. All we're going to be able to do on April 15th is tell you what you owe. There's no planning available to you on April 15th. Remember these new things that have come into place from the new tax law. Like I said, we kind of cherry picked the ones that I thought would really affect all auto repair owners. So pay attention to those things. Remember that timing matters. The time to start is now. Most shop owners just miss out because no one's helping them think through these things. So take some time, make an appointment with your tax pro, make sure that they're aware that you're interested in tax planning before year end. So again, what we provide our clients, we do weekly financial check-ins. And by that, we're updating your books every week. So every week you can have a profit and loss of how you did last week, which is a big deal for our repair guys. They love looking at last week's P&L. We offer profit first cash management systems, as we've already discussed. Read the book, open the account, stick to it, or we can help you implement that and help you set up your allocations and how to manage that process. If you buy our fractional CFO services, we can help you with a 13-week cash flow forecast, which is an amazing tool. Remember, all your bookkeeper's doing is helping you report on historicals and what has already happened. A 13-week cash flow makes you start looking forward into what things are going to be in the future. And of course, strategic planning is always part of our offerings. Dylan and I that's the funnest part of our job, is talking to our owners and talking about what's going right, what's going wrong, and how we can help them from a financial position, make things better and allow them to sleep at night, which is the goal.
Yes, for more information or to inquire about our services, you can see it there on screen. You can email us at info@redlineba.com. You can call us at our number 512-518-5556. We have a website that's got lots of great information. That's redlineba.com. And lastly, but not leastly, if you tuned in late to this meeting or you'd like to review any of the information discussed, we always upload these videos to our YouTube channel, which is easy to find because it's Redline Business Advisors. We have all of the previous webinars. We will have this webinar and we'll have future ones for you to peruse at your convenience. And we look forward to seeing everybody next time. Thank you, everyone, for joining. Thank you, Nancy and Dylan, for giving a wonderful presentation. Everybody stay on top of those taxes. It's better to do it beforehand than have to deal with the consequences later.
Yeah, rip
that
Band-Aid off. Bye, everybody.
Bye-bye, everybody. Have a great rest of your day.